Good evening. Or perhaps I should say, for the vast majority of you, this is the last good evening you will see for a long time. Today is December 28, 2025. There are 3 days left until the year ends. I hear you celebrating. I see the current market sentiment. You are clinking glasses, drinking heavily, staring at those ticking account balances, thinking you are geniuses. Champagne on Wall Street must be sold out, right? I know this atmosphere well. I saw it in 1929th. I saw it in 1973rd. I saw it at the peak of the dot-com bubble in 2000. And I saw it on the eve of the supreme mortgage farce in 2008. It is a stench I recognize, a putrid smell filled with greed, ignorance, and arrogance. Although I am no longer in your world, right now mathematics is still the universal language, and the mathematical formulas I see right now are screaming. They are flashing read alerts, yet you choose to turn a blind eye because you are too busy staring at stock charts. I am not sitting here today to please you. I never cared if you liked me. I am here to tell you a simple, brutal, but absolutely inevitable truth. In 2026, the U.S. stock market faces an epic collapse, a literal halving. If you don't listen, half of your wealth will be wiped out in the next 12 months. Did you hear me clearly? Down 50%. Not a mild 10% correction. That's a word for children playing house. I'm talking about a slaughter, a reckoning, a violent movement of mean reversion. Why? Because you have violated every iron law. I have spent my whole life talking about invert. Always invert. If you want to know how to go bankrupt, look at what the market is doing now, and do exactly that. But if you want to survive, listen to the 5 signals I am about to tell you. These are not predictions, these are mathematical facts that have already occurred. Signal 1, the total failure of mathematical logic, negative risk premium, negative ERP. Munger picks up a chart showing 2 lines U.S. Treasury yields and the S&P 500 earnings yield. The lines have crossed and inverted. This is the first signal, and the one that disgusts me the most, because it shows that the entire investment community has lost even the most basic ability to do arithmetic. Let's go back to common sense. What is the essence of investing? You put up a sum of money to gain more purchasing power in the future. For this purpose, you take on risk. You buy stocks because stocks represent ownership in a company. They carry risk, so they must offer a higher return than keeping money in the bank. This is called the equity risk premium, ERP. This is the foundation of finance. Now, let's look at this foundation at the end of 2025. Right now, you can lift a finger and buy short-term U.S. Treasury bills, T-bills, and you will get a 5% risk-free return. That is risk-free. As long as the U.S. government doesn't collapse, that money is yours. You can sleep like a baby at night. But what are you doing? You are frantically buying the S&P 500. What is the P/E ratio of the S&P 500 right now? About 33 times. If you invert that number 1 divided by 33, you get the earnings yield of stocks, which is about 3%. You understand? The risk-free return is 5%. Yet you are braving huge market risks, policy risks, and war risks to buy an asset with a theoretical return of only 3%. Is there water in your brains? Or has greed burned out your hippocampus? In a normal market, stock yields should be 3% to 4% higher than treasuries, meaning you should demand an 8% to 9% return to justify the risk. But now, the risk premium is negative 2%. This means you are paying the market to let you take risks. This isn't just stupidity. It is suicide. It's like walking into a casino where the dealer tells you, hey, you have a 50% chance of losing everything on this hand, but if you win, you'll pay you 0.5 times your bet, and you excitedly push all your chips in. This inversion of mathematical logic cannot be sustained. Never. It's like gravity. You can jump and leave the ground temporarily, but you must eventually come down. When the risk-free rate is as high as 5%, money is very expensive. Capital has a cost. Every dollar not used to buy treasuries is losing that 5% opportunity cost every second. It's like a giant black hole. When the smart money, though there doesn't seem to be much left when the money that actually knows arithmetic realizes, hey, why am I risking a 50% drop for a 3% yield? What will they do? They will retreat. They will sell stocks and buy bonds. And when that process starts, what happens to that 33x P ratio? It collapses. To make stocks attractive again, prices must fall until the earnings yield returns to a reasonable level above treasuries. To do this math problem, how much does the stock price need to drop? Simple math to turn a 3% yield into 8%, assuming 5% risk-free plus 3% premium. Stock prices need to fall by more than 60%. So, when I say a 50% drop, I'm being generous. This is the first signal. You are buying into a mathematical certainty of loss. Signal to the lame giant extreme imbalance in market structure. Munger puts down the chart, leans forward, clasping his hands on the table. If the first signal was about price, the second is about structure. You are always talking about the great American bull market. You look at the index rising and think the economy is great. That is an illusion. It's like attending a banquet where you see only 7 people frantically eating lobster and drinking Lafite. Strong as oxen meanwhile, the other 493 people in the room are starving, emaciated, or lying on the floor dying. Then you point at those 7 and say, look, the people at this banquet are so healthy. This is the SP 500 today. Your so-called bull market is entirely propped up by those magnificent 7 tech giants. At the end of 2025, these 7 companies account for a staggering 42% of the total market capitalization. What does this mean? This is monopoly. This is deformity. This is extreme fragility. If you remove these 7 companies, Nvidia, Microsoft, Apple, Google, and the like from the index, what is the performance of the remaining 493 companies SP 493 over the past year? Zero or even negative. Traditional manufacturing, consumer goods, and energy companies have actually entered a bear market. Their profits are sliding. Their stock prices are bleeding out. But the index covers it all up. The index is like a thick layer of makeup covering a face full of pockmarks and sores. This one-legged market structure is incredibly dangerous. I call it camouflaged hell. Why is this fatal? Think of my Lollapalooza effect. If the market is broad-based, even if 1 or 2 industries fail, others can hold up the broader market. But now, the fate of the entire market hangs on those few thin wires. If Nvidia's chip demand slows down even a little, if the antitrust stick finally hits Google or Amazon, if Microsoft say monetization falls short of expectations, if any one of these 7 companies sneezes, the entire SP 500 catches severe pneumonia. Furthermore, we must understand one thing: the law of large numbers cannot be defied. These companies have grown to absurd sizes. They cannot grow at 50% a year forever. On this finite earth, no organism can grow infinitely until it breaks through the ceiling. The moment growth slows down, and believe me, that is coming in 2026, is the beginning of valuation slaughter. Current market participants, whether fund managers or retail investors, are trapped in a passive investment trap. Because the index rises, passive funds must buy the index. Because they buy the index, they must buy the 7 companies with the largest weights. Because they buy those 7 companies, their prices continue to rise. The index continues to rise. This is a self-reinforcing death spiral. But like a Ponzi scheme, this cycle needs a constant stream of new money to sustain itself. Once the music stops, once inflows turn into outflows, this cycle accelerates in reverse. That is a stampede. While the doors are narrow and everyone wants to squeeze out at the same time. When that happens, you will find that the so-called liquidity vanishes instantly. The remaining 493 companies are already out of breath and can't support the market, and once those 7 pillars snap, the ceiling will crash directly onto your floor. It's not if, it's when. In my view, this extreme concentration is nature sending us a signal. The ecosystem is out of balance. A forest fire is brewing, and these dead branches and rotting leaves must be burned away for the forest to be reborn. And you are standing in the middle of a forest full of dry leaves, playing with matches. Munger pauses, takes a sip of Diet Coke. His gaze deepens. I have only covered 2 signals: the breakdown of math and the deformity of structure. These 2 alone are enough to make a rational investor liquidate their positions and hide in a bunker. But that's not the scariest part. The next 3 signals involve human madness, historical cycles, and what the real insiders are doing. That is what truly convinces me that 2026 is the endgame. Do you want to keep listening? Or do you want to turn off the video and go back to your pipe dreams of getting rich? I suggest you stay, because what follows might save your life. Part to the hammer of mean reversion, the great escape of the smart money. Munger adjusts his posture, tapping his fingers lightly on the desk. He picks up an old newspaper, a 1999 Wall Street Journal, then tosses it aside. Charlie Munger, you know what my favorite quote in life is? If you mix raisins with turds, you've still got turds. The current U.S. stock market is a turd that has been meticulously packaged and sprinkled with gold dust. No matter how Wall Street analysts garnish it with raisins like AI revolution or productivity leap, it remains fundamentally an overvalued, unsustainable bubble. And what peels away this gold dust is the 3rd signal. Signal 3, the Buffett indicator, is off the chart. Say collapse, as certain as physics. Warren Buffett's, I always like to look at the big picture. We don't care if earnings per share next quarter are up or down a penny. We care about is the price of this farm expensive relative to its output. This is the Buffett indicator: total U.S. stock market capitalization divided by U.S. GDP. It's like the price to sales PS ratio for the entire country. Historically, as long as this indicator is between 70% and 80%, buying stocks usually makes you a lot of money. That is the striking zone. At the peak of the dot-com bubble madness in 2000, when everyone thought the world had changed, this indicator hit 140%. Everyone said this time is different. The result, the Nasdaq fell 80%. Before the 2008 financial crisis, it was about 110%. Now, on December 28, 2025, guess what this number is? Munger holds up 2 fingers emphatically. 210%. The total market value of U.S. stocks is 2.1 times the U.S. GDP. What does this mean mathematically? It means the stock market has detached from Earth's gravity. It means stock prices have overdrafted decades of future economic growth. You have to understand one principle. While the stock market can detach from the economy in the short term, it must ultimately be a reflection of the economy. A company cannot be that much bigger than the economy that nurtures it. It's like a dog, it cannot grow to be twice the size of its owner. If it really gets that big, it's not a miracle, it's a tumor. For this indicator, there is only one path: mean reversion. This is the only physical law of financial markets. Trees don't grow to the sky. The higher the pendulum swings, the more violent the return swing. To get this 210% back to a reasonable 100%, which isn't even cheap, what needs to happen? Either U.S. GDP doubles in 1 year, which is a complete fantasy unless hyperinflation hits, in which case your money is worthless anyway, or stock market capitalization gets cut in half. This is arithmetic. Simple, brutal, and unfeeling. While you cheer for the SP 500 hitting new highs, I see a rubber band stretched to its limit, about to snap back right onto the bridge of your nose. Signal for extreme speculative madness. The last carnival in the casino. Munger sighs, shaking his head with a look of disgust. If overvaluation is just expensive, then current market behavior is insane. I have spent my life studying the psychology of human misjudgment, but I have to admit, the level of market madness in 2025 has refreshed my understanding. Look at the monster you have created. 0 DTE 0 days to expiration options. In today's market, more than half of the options trading volume is these options that expire on the same day. What is this? This is not investing. This is not even speculating. This is pure gambling. It's like a group of heroin addicts injecting their final dose straight into the vein. You no longer care about a company's cash flow. You no longer care about its moat. You only care if the stock price will tick up in the next 4 hours, so your few $100s of bets can flip 10 times. This makes the entire market extremely fragile. This short-term, massive leverage amplifies market volatility infinitely. Once the wind changes, this leverage will liquidate instantly, triggering a chain reaction. Also, look around you. This is the classic shoeshine boy theory, although there are no shoeshine boys anymore. Now it's your Uber driver recommending the next NVIDIA. It's your barber discussing option strategies. With you, it's college students who can't even read a balance sheet taking out campus loans to speculate on crypto and stocks. Margin debt has hit a record high. What does that mean? It means everyone is borrowing money to buy stocks. All the bullets have been fired. All the credit cards are maxed out. When the last fool has already entered the market with a full position, who is left to be the bag holder? No one. This is why I say this is the calm before the storm. All buying power has been exhausted. The market is like a room filled with gas. Just a tiny spark, maybe an earnings miss. Maybe a speech by a Fed official and the whole room explodes instantly. I am not against getting rich, but I am against stupidity. And the current market is a weapon of mass destruction powered by stupidity. Signal 5 insiders fleeing the ducks know first when the river warms. Munger lowers his voice, becoming more mysterious and piercing. If you think Warren and I are just old geezers who don't understand new technology, and that our warnings are alarmist, then why you look at what the people who created these myths are doing themselves. This is the fifth signal, and the most irrefutable one. Insiders are fleeing for their lives. Go check the SEC filings. Jeff Bezos sold billions of dollars of Amazon stock this year. Mark Zuckerberg is selling Meta almost every day. And your worship TI godfather Jensen Huang. His cash-out speed is faster than his GPU computing speed. Why? If you ask their PR teams, they will say, oh, it's just for tax planning to buy a yacht for charity. Bullshit. If they truly believed their companies would rise another 50% next year. If they believed the AI boom was just beginning, why sell now? Why not hold on to their chips tightly like they did years ago? Because they know their company's best. They know better than any Wall Street analyst where the limits of growth lie. They know better than any retail investor how many current orders are bubbles driven by customer FOMO. They know better than anyone how absurd the current valuations are. It's like the captain and first mate of the Titanic have quietly put on life jackets and boarded the lifeboats, yet they are still holding megaphones shouting to the passengers on deck, the ship is steady. Don't stop the music. Keep dancing. And you are really still dancing. When company executives, the people who know the inside story best, are exchanging stocks for cash, even while paying huge taxes, you, a small retail investor who knows nothing about the company, are adding leverage to rush in and take their bags. This is not investing. This is charity work. You are using your hard-earned money to provide liquidity for billionaires to cash out. Munger pauses, his eyes burning bright. Okay, now if you connect these 5 signals, mathematically buying stocks offers negative returns. Structurally, only 7 pillars are holding up the broader market. Valuation more expensive than the 2000 bubble. Sentiment national gambling, max leverage. Behavior bosses are cashing out and leaving. This is no longer a question of will it crash. This isn't even a gamble. This is a train speeding toward a cliff at full speed. And the brakes failed long ago. But that's not the whole story. Knowing the train will crash is one thing, knowing when and why it will crash in 2026 is another. Many will say, Charlie, the market can remain irrational for a long time. Maybe it can go up for another 2 years. No, this time is different, because 3 massive catalysts are approaching. They will converge in 2026 into a perfect storm, what I call the Lollapalooza effect. This involves the debt wall, the true face of the AI bubble, and the trigger the Fed will be forced to pull. You want to know why 2026 is the destined judgment day? Do you want to know how to flee the scene minutes before the disaster? Take a break. Drink some water. What follows might completely overturn your worldview. Part 3, Judgment Day 2026, the explosion of the Lollapalooza effect. Scene James. Munger holds a thick book. Poor Charlie's almanac. He opens a page and points to a word, Lollapalooza. Charlie Munger. Throughout my life, I have been teaching people a concept, the Lollapalooza effect. Originally a psychological term, it refers to when multiple tendencies or factors act in the same direction simultaneously. They don't just add up 1 till they create a nuclear like nonlinear amplification 100. This is why 2026 isn't just another bear market. Because in this year, 3 incredibly massive negative forces will collide at the same time and place. Any one of them alone is enough to trigger a recession. But when they come together, it is a perfect storm. This is why I dare to say 2026 is a mathematical dead end. Let's look at these 3 tipping points. Tipping point to the impact of the $3 trillion debt wall. Munger takes off his glasses, rubs his eyes, puts them back on, looking incredibly stern. Do you know what current prosperity is built on? Borrowed time and borrowed money. Over the past decade, especially during the pandemic, U.S. corporations borrowed astronomical amounts of money. Why? Because interest rates were near zero. If you can borrow at 1%, whether for stock buybacks or random investments, you look like a genius. But debt has a maturity date, and in 2026, a massive debt wall is about to collapse. According to my data, in 2026 alone, over $3 trillion of U.S. corporate debt matures. What does this mean? It means these companies must pay back this money, or in this is to refinance, borrow new to pay old in this new environment. But this time, the rules have changed. When they borrowed this money 5 years ago, interest rates were 1% or 2%. When they have to renew in 2026, rates will be 5%, 6%, or even higher. Imagine you own a company. You used to pay $100 million in interest annually, and you could barely make a profit. In 2026, your interest expense suddenly becomes $500 million. Your profit is instantly eaten up. Your cash flow turns negative. At this moment, you will discover that half of the so-called zombie companies in the S&P 500 have actually been dead for a long time. They were just kept alive by low-interest vendors. In 2026, the plug is pulled. This will trigger a wave of defaults and bankruptcies. This will not only destroy stock earnings expectations (EPS), but will directly destroy the credit market. Once the junk bond market collapses, liquidity will vanish like the receding tide. This is the first Lollapalooza, a factor, the violent reset of capital costs. Tipping point be the bursting of the AI bubble. Great technology, terrible business. Munger points to a flickering computer screen in the background. I may be an old fossil, but I admit, artificial intelligence AI is a great technological breakthrough. But great technology does not equal a good investment. Remember the automobile in 1900? Great technology, changed the world. But back then, there were thousands of car companies. In the end, only 3 survived. Investors lost far more money on car stocks than they made. Remember the internet in 1999? Changed humanity. But if you bought Cisco or Yahoo back then, it took you 15 years to break even, or you never did. Current AI is the internet of 2000. Everyone is frantically buying GPS, building data centers, training large models. It's like the fiber optic lane craze back then. Everyone thinks as long as they buy a shovel, they'll find gold. But even now, end of 2025, I want to ask you a question aside from Nvidia selling the shovels. How many companies have actually made real silver and gold from AI? I'm looking at financial reports. I only see staggering capital expenditures capex. Microsoft, Google, Meta are burning tens of billions of dollars a year on AI. The math doesn't add up. This leads to the second Lollapalooza factor, the disillusionment of our return on investment. By 2026, shareholders will start asking the fatal question, we invested hundreds of billions, where is the profit? When they find out that while AI can write poems and draw pictures, it cannot instantly boost the efficiency of ordinary companies by 50%, nor can it replace all employees. Disappointment will hit like a tsunami. It's like the eve of the dot-com bubble burst, when everyone suddenly realized, wait, the internet is cool. But how many years do we have to wait to make money selling dog food online? Once this narrative breaks, the valuations of the Mag 7 giants supporting the market will revert from price to dream ratios to utility stock levels. That will be a massacre for the index. Technology won't disappear, but the bubble must burst. That is the rhyme of history. Tipping point, see inflation strikes back, the Fed's betrayal. Munger sneers. Finally, the deadliest cut comes from the savior. You have pinned your hopes on the Federal Reserve. What is the market betting on now? Betting that the economy slows, the Fed cuts rates significantly, restarts the money printer, and saves the stock market. This is called the Fed put. Keep dreaming. You have ignored the elephant in the room, inflation. You think inflation is over? Look at current geopolitics. Look at the restructuring of supply chains due to deglobalization. Look at the U.S. government's unsustainable deficit spending. The roots of inflation have not been dug out. It's just lying low temporarily. History tells us inflation usually comes in 3 waves. Just like in the 1970s. The first wave passed. Everyone thought it was fine. The second wave's rebound was the killer. In 2026, when that $3 trillion in debt matures, causing chaos, and the government tries to print money to bail them out, inflation will pounce back like a tiger. This backs the Fed into a corner. If they cut rates to save the market, inflation will skyrocket, and the dollar's credit will collapse. If they maintain high rates or are forced to hike to hold down inflation, the debt wall and AI bubble will explode completely. If you were the Fed chair, what would you choose? Save the dollar or save the stock market? Volcker in history has given the answer. It will ultimately choose to sacrifice the stock market. So, 2026 will not bring the great flood of liquidity you expect. Instead, you will face stagflation, economic stagnation, soaring prices, and persistently high interest rates. For the stock market, this is the hell within hell. This is Lollapalooza. Debt matures, cash flow dries up, the AI story fails, valuations shatter, inflation returns, blocking the central bank's exit route. These 3 forces will converge into 2026. This isn't just a drop, this is a value shredder. If you are holding stocks with 50x PE, no dividends, living on stories, your asset value will go to 0 in this storm. This isn't to scare you. This is a physical phenomenon that is bound to happen. Now, do you understand why I say this isn't just a prediction but math? But I'm not done yet. It's easy to be a pessimistic prophet, but I, Charlie Munger, Never practiced pessimism for the sake of it. I am a realist. A realist not only sees the storm, but also builds an ark within it. Since we know 2026 is a destined catastrophe, as an ordinary person, what should you do? Wait like a lamb to the slaughter, or take action? The ark: how to survive the 2026 catastrophe. Alright, kid. I've painted the picture of the waterfall that's about to swallow you whole. If you've listened this far, it means you don't want to die. In the investment world, many so-called gurus will only paint pie in the sky, telling you how to make 10x returns. But today, I will only teach you one thing: how not to lose money. Sound boring? Let me tell you a secret. The first rule of compounding is to never interrupt it. And the fastest way to interrupt compounding is to let yourself go to zero. Facing the devastation of 2026, if you want to survive, or even pick up blood-stained chips from the ruins, you must execute these 3 actions now in these final days of 2025. Do not hesitate. Do not count on luck. Action 1. Ruthlessly liquidate pseudo assets. Throw away your rotten apples. The first action is the most painful, but also the most necessary. Open your account and go through all your holdings. Sell anything that fits one of these 3 characteristics. I don't care if you made money or lost money. Even if you are down 30%, chop it. PE ratio over 50th. Unless it is a company run by God, no enterprise deserves this valuation. No positive cash flow. If a company can't even feed itself and has to live on financing, in the debt storm of 2026, it will be the first corpse, living on concepts and stories. Companies that only have PETS and visions, but produce no real products, at this stage have no emotions. Stocks don't know you own them, and they won't love you back just because you love them. Many will say, oh, I'm down 20%. I can't bear to sell. I want to wait to break even. This is the stupidest psychological trap I see in humans: endowment effect and loss aversion. You are not waiting to break even, you are waiting to die. If the car is driving off a cliff, instead of jumping out, you want to stay in the car to look for your lost wallet. Sell now, and you might just suffer a flesh wound. Wait until 2026, and you will be shattered. Remember, cash in hand is better than paper wealth. Action to cash is king. Buy T-bills, learn to sit on your ass. After selling that garbage, where does the money go? Do not rush to buy other stocks. Even good companies will be slaughtered by mistake during a great crash. What you need to do is convert all your bullets into short-term U.S. Treasury bills, T-bills. Why? First, it gives you 5% interest. In a world full of risks, this is the only free lunch. Second, and most importantly, liquidity. I know holding cash is uncomfortable. Watching others party makes you feel like a fool. This is called FOMO, fear of missing out. But you must learn the skill I am best at: sit on your ass. Holding cash isn't just for that 5% interest, it is for the option value. So when the crash comes in 2026, when the streets are full of blood, when those once high-flying good companies like Apple cost could drop 50% and become cheap everywhere, who is the master of the world? The person with cash. At that time, you are not fleeing, you are shopping. And everything is 90% off. That is the only opportunity for you to jump social classes. So, be a boring person now. Buy T-bills. Go play golf. Go read books. Wait for the prey to fall into the trap itself. Action 3. Minimal allocation to anti-fragile assets, the last insurance. If your hands are really itching, or you want to leave yourself a final line of defense, then allocate a maximum of 30% of your funds to assets that do not fear inflation or crashes. We are looking for things that are anti-fragile. Energy, oil, gas. Even if the stock market crashes, the world still needs to burn fuel. Geopolitics worsen. Oil prices might even skyrocket. This is the best tool to hedge against war risk. Consumer staples companies that make toothpaste, cola, diapers, No matter how bad the economy is, people still need to brush their teeth. Although boring, they are unsinkable aircraft carriers in a storm. Gold real money. When dollar credit shakes due to money printing, gold is the final anchor of trust. But please remember, do not exceed 30%, because in an extreme liquidity crisis, even gold gets sold off. Cash remains the absolute main force. I know, even after I've said all this, 95% of you behind the screens will do nothing. You will turn off the video and mock me as a washed-up old fool. You will continue watching stock prices rise, enjoying the dopamine rush. You will tell yourself, I'll leave after making the last 10%. Believe me, no one can earn that last 10%. Nassim Taleb told a story about a turkey. A turkey is fed well by the farmer every day. In the turkey statistical model, the farmer is the person who treats it best. Life will only get better, and trust peaks on the 1000th day. Then, the 1001st day arrives. That day is Thanksgiving. The current U.S. stock market is that turkey on the 1000th day. All indicators look so beautiful, all feedings are so timely. But I have already seen the menu for the 1001st day from the other side. It has your names written on it. I am Charlie Munger. I have spent my life pursuing rationality, even if it makes me seem unkind. My warning has been issued. The doors are closing. The ark is about to set sail. Either leave gracefully now, taking your profits and your dignity, or stay in the game and become another footnote about greed in the history books. The choice is yours. Goodbye.